Hey everyone, thank you for joining us. My name is Corey Hoffstein. I am CIO of Newfound Research and one of the co-founders of the Return Stacked suite of funds. And I am delighted to be joined today by Rodrigo Gordillo, president of Resolve Asset Management, as well as co-founder of the Return Stacked suite of funds. If you haven't heard of the Return Stacked lineup before, ultimately what this suite aims to do is unlock the benefits of diversification by allowing you to introduce alternative investment strategies and exposures into your portfolio without having to sacrifice core stock and bond exposure. Each fund in the suite follows the same simple formula. For every dollar invested, we're going to provide a dollar of either core stock or bond exposure, plus a dollar of exposure to an alternative asset class or investment strategy. We launched our first funds in the US back in February 2023, and the whole suite has just passed over $850 million in assets, rapidly on its way to a billion, hopefully. Today, I am really excited to have Rodrigo talk specifically about the Return Stacked Global Balanced and Macro ETF, ticker RGBM, where he's going to get a chance to walk through the many ways that this ETF works and can be utilized to enhance portfolio diversification and allow for all sorts of different types of stacking opportunities in your strategic allocation. Really importantly, in this webinar, you should feel free to ask questions along the way. There's a Q&A chat box that you can ask questions, and I'll be responding to the questions live in real time or bringing them up to Rodrigo if he can bring some color to them as well. And that's it. So Rodrigo, let's start with the question, what is return stacking, right? So for those of you who are joining us for the first time who haven't heard this word before, this idea is central and core to what we do with our lineup. And it really begins with the idea of diversification. Let's jump to the next slide. Historically, when we talk about diversification, it's been a process of what I like to say is addition through subtraction. In this industry, we agree on very few things. One of the things we agree on is that all else held equal, more diversification is better than less. But to add diversifying assets and strategies into an existing portfolio, it has historically required making room by selling things we already own, typically stocks and bonds. And so a lot of proponents of diversifiers will say we should use this idea of a 60% stock, 40% bond portfolio, sell some stocks and bonds, and move to what they're calling the modern 60-40, being a 50% stock, 30% bond, 20% alternative portfolio. And this may look really good on paper, particularly when you look at the returns over the long run. But this type of addition through subtraction, making room for diversifiers in your portfolio, can lead to a lot of behavioral frictions along the way. So let's go to the next slide. What this slide shows is the relative performance of that 50-30-20 portfolio versus a 60-40. When the line is going up, the diversifiers are adding value relative to stocks and bonds, and when the line is going down, they're underperforming the stocks and bonds you sold to make room. And what we see is that during the early 2000s, people loved alternatives. This was a period where diversifiers were working really well. For those of you who were in the industry at the time, I'm sure you remember everyone was adding commodities and gold and emerging markets and long short equity and global macro managers. These types of strategies worked really well, and clients really embraced diversification. After the great financial crisis, we saw a very different picture, which was that diversification underperformed concentration in stocks and bonds. And as much as we wanted to preach that hypothetically on paper, more diversification was better, the realized experience for most investors was that they continued to underperform the stocks and bonds that they tend to know and love. And so they kept putting pressure on their wealth managers to move them into simpler, low cost, more transparent, more tax efficient portfolios, closer and closer and closer to that 60-40, making it very hard to maintain that diversification for when it became beneficial again, particularly in a year like 2022. Let's jump forward to the next slide. So this is where return stacking comes in. What is return stacking? How does the return stack suite of funds try to solve this problem? Well, for every dollar you invest in a return stacked fund, we're going to provide a dollar of either core stocks or bonds, plus a dollar of exposure to some sort of diversifying alternative. What this means is that when you buy the fund, you don't have to give up exposure to the core stocks and bonds that the client knows and loves and appreciates to get that exposure to that beneficial diversifier. Let's jump to the next slide. So on the far left here, to illustrate how this works, we have your traditional strategic asset allocation, your traditional benchmark portfolio. Here, 60% stocks, 40% bonds. In the middle, we show the traditional old world approach to making room for alternatives. Here, we sold 10% of the stocks, sold 10% of the bonds, took that 20% allocation and put it in alternatives. This is that 50-30-20 chart that we showed before. When you use a return stack solution, because every dollar you put into a return stacked fund gets you a dollar of those core stocks and bonds back, what you can actually end up with by selling stocks and bonds and buying a return stack solution is getting your core stocks and bonds back and adding that alternative as an overlay to the portfolio or stacking it on top of the portfolio, right? So now instead of a 50-30-20, you retain your core 60-40, and that 20% exposure is now stacked on top of your strategic asset allocation. And what this does importantly is it hopefully helps mitigate some of the behavioral issues that can come along with trying to access diversifiers. So we've taken the same graph we saw before, but now instead of comparing a 50-30-20 to a 60-40, we're comparing a 60-40-20 to a 60-40. Maintaining the strategic core, stacking the 20% alternatives on top. And you can see that during a period that alternatives did well, we still get those benefits in the early 2000s. But then in a period where alternatives underperform stocks and bonds in the 2010s, we no longer have the opportunity cost, right? No longer is diversification a process of addition through subtraction. We can simply add the diversifying alternatives on top of the 60-40 or whatever strategic allocation you choose. And therefore, as long as those alternatives are outperforming the hurdle rate, which is cash, we can actually still see some benefit in the portfolio, even when they're underperforming stocks and bonds, hopefully making it easier for clients to stick with them, maintain them so that they are there when the beneficial diversification properties emerge in a year like 2022. Let's jump to the next slide. So there are really two key benefits to this idea of stacking. The first is by taking alternatives and stacking them on top of your core stocks and bonds, you can actually try to pursue different means of outperformance. You're adding another unique, hopefully diversifying return stream on top of your stocks and bonds. And by just adding something more on top, you can try to beat that core stock and bond exposure. And hopefully what you're adding on top is something you have high conviction in, not only being an uncorrelated from stocks and bonds, but something you think is going to generate positive returns with high conviction over the long run. The second thing that's important here is you can stack for diversification, and that's really what we've spoken about before. Stocks and bonds should be the core elements of every portfolio, but as 2022 laid bare, inflationary shocks tend to make stocks and bonds go down at the same time. And so when we look for a third leg of the stool, what return stacking can enable us to do is add diversifiers to the portfolio without disrupting that stock and bond core, hopefully making it easier for allocators to hold on to those diversifiers for those periods in which they are going to be most needed. All right. So Rodrigo, with that introduction of what is return stacking out of the way, I'm really excited to turn it over to you here so you can dive into a practical implementation of the return stacking idea with our new return stacked global balanced and macro ETF.
Thank you, Corey. That was a great introduction to the return stack concept. And what I'm going to try to do now for our Canadian and international investors is really try to get deep into the latest exchange traded fund listed in the Toronto Stock Exchange. This is the return stack global balanced and macro ETF, ticker RGBM. So just starting with kind of the base investment case here, as Corey alluded to, the key component of all of our return stack lineups is the concept of capital efficiency, that you can do a lot more for your clients' portfolios with a lot less money. So in this particular product, for every dollar that you buy in RGBM, it aims to provide a full dollar exposure to a global balanced allocation strategy. So that's a 50-50 stock bond portfolio. And then another full dollar exposure to a systematic macro strategy, which I'll get into what that actually means later in this presentation. Now, the key thing here from a diversification standpoint is that you really are getting three very key diversified components. Equities and bonds act differently most of the time, not always, as we saw in 2022. And then systematic macro has long-term, if you look at any systematic macro index, very low correlation to equities and bonds, close to zero, right? So three key non-diversified components where the systematic macro strategy tends to do well in periods of pain. It tends to do well in periods of inflation. Given the components that we are able to invest in commodities and being able to short bonds in periods like 2022, there's an opportunity here for profiting during periods of inflationary shocks like we saw in 2022 and we may see in the future, or even bear markets. And then another key structural component that is only unique to this Canadian ETF is the tax efficiency aspect. Shareholders here are not expected to receive any taxable distributions, which would be a tax saving for non-registered holders and absolutely instrumental in the overall return from an investment like this. Because in Canada, while there are a number of managed futures managers out there, managed futures are marked to market. Whatever gains you have are marked to market every year, whether you sold your investments or not, and then that is taxed as income. And so while even in taxable accounts, managed futures as a diversifier is great, you don't get to keep a lot of the returns as time goes by. This changes everything, right? The tax efficiency of the CTF means that when you invest, we don't expect any distributions, and therefore you can compound the wealth for your clients inside the CTF long term. Now let's get to the nitty gritty of what betas and what alphas we're stacking here. As mentioned before, we're trying to do $1 of a balanced allocation and $1 systematic macro. Now the balanced allocation is a 50% exposure to global equities, and this is an unhedged exposure to the global equity markets that includes US and global. And so you're going to get the currency exposure for any global markets, and you're going to get the currency exposure in the US. And then the 50% Canadian bonds is going to be a exposure to Canadian futures contracts. And then on top of that, we're going to stack the systematic macro strategy that Resolve Asset Management has been running for years. And again, this is designed to be lowly correlated and provide a lot of diversity. Now, let's talk about the big alpha component. What is systematic macro? And I think a lot of investors have heard of macro investing. And I want to differentiate what fundamental macro is, which I think is the most common, to systematic macro. Fundamental macro is often, it tends to be personality based, where there's a big decision maker or a small group of decision makers that are looking at currency and global markets, bonds, and commodities, and making large bets based on something that they're seeing in the market structures. It is very different than a systematic macro strategy, where while we are in the same arena, we're looking at investing long and short equity indices globally, long and short bond global indices, long and short commodities and currencies. The approach is much more systematic. The goal here is to maximize diversity, minimize, the reliance on any single bet that we hope actually comes to fruition. And it's more about finding small edges across things like trend, seasonality, mean reversion, carry, which we'll get to in a second, right? So we want to just spread out our bets and make sure that the work that is done on trying to extract long-term premiums on anomalies that we find, all the work is done up front, years and years of research, make sure that we codify it. And then the next step in this word systematic has to do with the fact that we're going to be executing those models religiously. It is 100% rules driven, right? So we are governed by our algorithms, and then we want to execute those trades without any emotional bias. And we want to make sure that whether it's sunny or dark outside in the weather, which we know has effects on decision making, we want to make sure that we are executing religiously. Did we feel a lot of emotions over the last few days? Absolutely. Did it affect the way that we are going to execute? Absolutely not. That's why we're systematic. As I alluded to as well, it's multi-asset and global focus, right? Commodities, bonds, currencies, and equities. And then it's the directional flexibility that also sets it apart from most categories in the hedge fund space. So when we look at the hedge fund space, we see a lot of long short equity. That tends to be long bias systematically. Market neutral tends to be neutral most of the time. Systematic macro and things like managed futures trend take a different view. Long-term correlations are around zero to stocks and bonds, but they do take directional bets. When things are moving up, when equities and bonds are moving up, and there is enough patterns to say, hey, this is a good idea to invest in bonds, we will be net long along with equities and bonds plenty of times. But if those markets shift and start showing different patterns, we have the ability to be net negative correlation to those markets. So the directional flexibility allows us not just to provide interesting long-term returns, but also to provide really strong offsets in periods of abrupt market change. And we'll get to that later in the presentation. And the final thing that's super key behind systematic is the risk management. So we manage this systematic macro to a target volatility of around 10%. And what that means is that we are constantly measuring the overall portfolio risk. We're also measuring the sector risk. We're measuring the security risk. We're creating certain limits as to how much we can own of each. And then if a period like the last month, if we find that volatility is expanded across all assets, the first thing that's going to happen is there's going to be a reduction in gross exposure to meet that volatility target that we're aiming for, right? So while a 60-40 will go from averaging around 12% a year, and then all of a sudden having a 45% standard deviation spike, what we're going to do here is we're going to make sure we manage that risk so it doesn't get as high ever. And we're going to try to keep it within a reasonable band. And that's the key difference, and that's the value added, we think, of systematic macro. And so what I'm showing you here is just kind of disaggregating the three components that we are looking to invest here in RGBM. The black line represents global equities. The blue line represents Canadian bonds. And the green line depicts the Pivotal Path Global Macro Quantitative Index, which is just an index of managers that are trying to do multi-strategy in the managed future space, long and short. And what we can see clearly here is the benefits of diversification of systematic macro to both Canadian bonds and global equities. Okay. What is also interesting is in periods like the tech crisis, in periods like 2008, less so in 2020, and definitely in 2022, it has exhibited positive returns and offsetting characteristics that I think everybody here would agree would be crucial to have at the right time. And when we look at just those periods, the tech crisis, and see how well they did, you can see that the bar in black is equities, in green it's bonds, and then you have your systematic macro. Clear diversifiers and offsetting losses from the equity markets. Similar in 2008. In 2020, both bonds and systematic macro had a bad period. And this tends to do with how abrupt the shift in regimes happened, and that systematic macro tends to take a little bit of time, in any managed futures, any active strategy tends to take a little bit of time to shift into the new regime. So it is expected to take a first hit if the shift is abrupt enough and before it adapts to the new regime. But we can see here in 2022, where it was a bit slower of a regime shift, you can see the benefits of the offset. And what are we trying to do ultimately with this ETF? Well, first, we're trying to solve an old problem, and it's an old behavioral problem. I think if anybody's in this presentation, I'm guessing that in their past, they have allocated to diversifiers. In the past, they may have allocated to something like managed futures. I know that Man AHL was very popular in 2008. I owned them through 2006, 7, and 8, and they were very, very useful to me then. But then we struggled in the next 4 to 5 years, and it's really, really difficult. And the pitch for these managers had always been, hey, look, you are this black line. In this case, the black line here is a 50-50 bond equity portfolio. And the pitch was, look, you're here. This is your portfolio. This is the diversifier. And guess what? If you add this green line and this black line, you get a magical, beautiful line that's much more, much less volatile, much more consistent, and your clients are going to benefit from that. And this is the mountain chart in gray in the back, right? That was the promise. But the reality was that clients didn't see the portfolio level beauty of this. What they saw is a period post 2014, maybe, where systematic macro did positive but single digit returns, right? This is tough to try to go back to clients when the rest of the portfolio's line items are going up 10, 15, sometimes 20%. And then you got this green line item doing 1 or 2 or 3%. So the big unlock from a diversification standpoint is the fact that that the return stacked ETFs allow you to provide a single line item that actually aims to provide this gray mountain chart in the back. And the goal here is to really allow the client to participate in the markets that they really know and understand while benefiting from the diversification that they need. And I think this is one of the major reasons why we've grown so quickly in the United States. This is now starting to come into Canada, and it's something that we all in the Canadian space are going to have to think about more deeply. So again, this gray line here is 100% balanced allocation, 100% systematic macro. Okay? Now let's talk about how we get exposure to the balanced allocation. So the goal here, the target exposure, is to have 50% in global equities and 50% in Canadian bonds. And this is a decision based on speaking to advisors, where most advisors do have some global equity exposure and also have some Canadian bond exposure. And if they were going to be swapping out something from their portfolios, it would make sense to swap out some of the Canadian, sell some of the Canadian bonds, sell some global equities, swap this in, get those allocations right back, and then get the stack on top. Okay, so how do we get this in a capital efficient way? Well, a way of doing it here is we could buy an ETF of global equities. And then with the other 50% of the allocation, we kind of leave it in cash, have a liquidity buffer there. We'll buy T-bills here in order to get some yield. On the margin in the broker dealer allows us to then buy a Canadian bond futures contract at the full exposure, notional exposure that we need, right? So this is a simple way of getting exposure to Canadian bonds while maintaining a lot of cash liquidity for the systematic macro, which I'll walk you guys through a little later on. All right, so what are some of the key underlying strategies that govern the systematic macro component of RGBM? Well, a lot of you, when I say managed futures, it's almost synonymous to trend following. And while that has evolved, obviously, into systematic macro, most people will understand and have been exposed to managed futures trend following because they've been around, like the turtle traders back in the 80s were basically using futures contracts and trading long and short based on breakout systems and trend lines and moving average crossovers. So this is obviously the one that's been mostly talked about. But the reality is that selecting when to go long and short any market can have you can have more than one style that tends to do well, similar to how value investing over the long term can make money, and momentum investing also can make money over time, but they're non-correlated to each other, or growth investing for that matter. There are key risk premias that we have identified that have fundamental reasons to exist, but are not necessarily highly correlated to each other, right? So in this case, we have a component of trend following. And trend following is a tendency for an asset recent performance to continue in the future, right? So that's let's say we have gold, and gold has had a big run up. Trend following might say, I want to have 5 units long gold. Then we go to mean reversion. I think a lot of people know what that probably means. And we ask mean reversion systems, hey, how should we position for gold? Maybe gold's got a 6 standard deviation move recently, and it's saying, listen, this is a crazy move upwards. We're probably going to mean revert. I want to sell short 3 units. So now we're, +5, -3, we're long 2. And then we go to the seasonal systems and say, hey, are we entering a good or poor seasonal period for gold? Maybe it's a poor seasonal period. We should be shorting 2 units. Now we're flat gold, right? So, and on it goes, right? So seasonality, if you want to see the success there, I think a lot of Canadians have been exposed to HAC ETF, which has done a great job of using seasonal patterns to create alpha. And then, other ones that you guys may have heard of or not is carry. And this is multi-asset directional carry. It's not the carry that oftentimes gets confused with currency carry, or, the carry trade between the Japanese yen and the US dollar. This is carry across all markets. And it's really just looking at the tendency for higher yielding assets to provide higher returns and lower yielding assets to provide lower returns. And we'll go long one and short the other based on those metrics. And when you look at multi-asset carry long term, it tends to have protective qualities. It doesn't necessarily lose money when there's a bear market. Actually, sometimes it mostly offsets it over enough period, if you give it enough period time to breathe. Skewness is a tendency for assets with asymmetrical distributed returns to exhibit higher returns as compensation for tail risk, right? So if we see that there's a big distribution of an asset class that has a big fat right tail, we are going to take that and take the opposite bet to get compensated for that risk, whether it's the left tail or the right tail. And then relative value is the tendency for assets priced relatively lower compared to their peers or fundamentals to outperform higher price counterparts. So this is kind of fairly straightforward, right? So you put all these together, and the goal here is, all of these tend to make money over time. They don't make money at the same time. They're all kind of systems that are 50, just over 50% accuracy over time. And when a handful of them or most of them agree on directionality of the asset, you end up getting some positive returns in that asset, and it just smooths out the return stream, right? More diversification. They all make money. They make it in different times.
Rod, I think you're touching on it well on this slide, but just to ask a question explicitly that we got asked here, how much trend and carry is in the macro sleeve, and how much overlap would you expect from a correlation perspective of a systematic macro program with a standalone trend program or with a standalone carry program?
Yeah, great question. And look, if you look at the long-term correlation of systematic macro strategies to trend, long term, you tend to see actually a positive like 0.4 to 0.5% correlation to trend. But this is, again, looking at the average, right? In any given time, if you look at any systematic macro strategy, at any given time, if seasonality, mean reversion, carry are making money and trend is losing money, then the systematic macro strategy will be negatively correlated to trend following. And so there are many periods where trend following does really poorly, and the conglomerate of all of these signals actually offset and more than offset the losses in trend following. We actually have seen that, like we saw it last year in our strategies where trend following had a kind of flat to down year, whereas the systematic strategies as a whole were positive, right? So again, similar to how systematic macro is conditionally correlated to equities, sometimes positive, sometimes negative, and conditionally correlated to bonds, so systematic macro is also conditionally correlated to trend following and everything else. And in terms of the weighting scheme, over the long term, the weighting across all these is equal weight. But over the short term, we are looking at every single market and the strength of trend, the strength of mean reversion for any one of them. And when you add up all of the existing weights as to how the system is overweighting or underweighting these, at any given time, you will have certain systems be overweight and underweight based on the market opportunities at the time. But long term, it's average exposure. Okay. All right. So again, all of these systems here, every one of them is making decisions and bets on what to go long, what to go short across a wide variety of asset classes. And here, kind of summarize 15 markets in agriculture, 9 bond markets globally, 6 rate markets, 8 energy markets, 11 equity markets, 7 metals, 8 foreign exchange markets, and 2 volatility markets in Europe and the US. And again, we're making decisions using these signals as an aggregate to decide how much and which markets to go long or short. All right. So when we put all this together in terms of what happens to the dollar that you give us and how it gets deployed, once again, you give us a dollar. What's going to happen is we're going to invest it in a global equity exposure. Then we're going to keep a bunch in cash. We're going to use some margin to both get exposure, simultaneous exposure to the Canadian bond futures, as well as the full, 50 plus long, short managed future strategy or the systematic macro strategy. All right. So that's when you stack it all up, that's how you get your 50, 50, and 100. All right, so how does this work? Just going back to Corey's original slides. Well, the way that there's a few ways to kind of use this, but the most common way that we've seen this being used is basically saying, okay, look, how do I make it so that I keep up with my competitors and I need to provide a return that's reasonable to what everybody else is doing. And if I have a 60-40 portfolio and I underperform drastically, that's a problem. So what can you do? You can maybe sell 10% of your equities, sell 10% of your bonds. Now you have 20% cash. What you'll do is you could buy RGBM here. And what your clients will see then is a 50% allocation to equities, a 30% allocation to bonds, and a 20% allocation to RGBM. That's what they'll see. But if you put your X-ray goggles on, what you're actually doing is you're sneaking in that diversification. You're giving your clients exactly what they want, which is that 60-40 again, but we're sneaking in that non-correlated return stream on top. Okay, so this has been the most common implementation for people that have no alternatives, know that they need it for their clients and just haven't been able to behaviorally find a way to do so. This is a nice little way to keep what you want and have what they need. There's another use case that is managers that already own managed futures products. Maybe their portfolio is something to the effect of, 50% equities, 30% bonds, and 20% managed futures. And they don't want to stack. They like that 50, 30, 20 traditional allocation. Well, the interesting thing is that you can actually use this ETF to get the exact same exposure. But what you're doing that is unique is that you're eliminating the line item. No, you're not eliminating that. You're reducing the line item behavioral risk, because what you would then do if you have 50, 30, 20 is you could maybe sell another 10% of your equities, another 10% of your bonds, and sell the managed futures that's giving you trouble, buy with half of the cash raised, RGBM, and your clients will see 20% cash, 20% RGBM, 40% equities, 20% bonds. That's what they'll see, and they'll feel maybe that there's some comfort in having some cash and that the allocation has changed. The RGBM becomes that mixed beta alpha bag that is easier to hold. But when you X-ray, you're actually right back at the allocation you wanted initially, which is a 50, 30, 20. Okay. So if you have any managed futures or any alternative managers that you're really struggling with and you don't know what to do with them, this may be an interesting approach where you're using return stacked ETFs to not necessarily stack, but to hide some of that weird movement of the alternative sleeve.
Rod,
All right, so just
can I interrupt on that last slide?
Sure.
So, right, we've been using this 60-40 canonical example throughout the whole presentation. One of the questions we got asked is around younger clients who are putting a lot of money in just global equities and that's it. And the question was around how can RGBM be positioned potentially as an alpha add for young clients who are very equity centric?
Right. Well, let's think about some of the long-term realities of each one of these asset classes. So you have The equity risk premia being something to the effect of 4.5% long term. The term premium, as in like what bonds give you, is around, 2 real, maybe 2 to 2.5 real. And what we expect from the systematic macro is, maybe 300 to 400 basis points long term, right? So when you look at the opportunity cost long term here is equity risk premium and the what we expect to see from the systematic macro. I think they're roughly equal in terms of returns and absolute returns. Okay. The bond premium tends to be slightly lower. Okay. But the way you could rearrange these blocks for your younger clients could be, you're getting 50% of the equity risk premium. You're getting 50%, you're getting 100% of the systematic macro. Okay. And that should, over the long term, if my assumptions are correct, do the same or better than equities. And then you also have that bond component. Now think about like rearranging, you're stacking the bonds on top, you're stacking that term premium that acts in interesting ways, right? If there's a non-inflationary bear market, that'll act to buffer some of the losses on the downside, along with hopefully systematic macro. And then there's a final value of diversifying 3 unique return streams. I know that nobody likes bonds, but especially young people seem to not like bonds, but they're missing out on what Corey and I have written about extensively, which is this diversification premium or rebalancing premium, right? If you just add up the returns of these 3 asset classes long term, and you just add them up, this plus this plus this, you are not actually going to equate to the reality of a rebalanced portfolio. What we're rebalancing daily here, because the rebalancing premium is really capturing the mean reversion elements of all of these. So when you combine 3 unique return streams, and you are constantly rebalancing. There's a loser that just went down. You are grabbing from the winner, giving it more to the loser, and there's a bit of a rebound. What we found in our research is that we've seen an extra 1, and sometimes depending on how the markets went, an extra 1 to 4 percentage points extra return purely on the rebalancing, right? So again, just to recap and answer your question, you got a young client that wants equity returns. Well, I think just purely by equity risk premium plus term premium plus systematic macro premium, I think it's competitive. I'm highly confident it will be, probably be better. But we don't know. So I think it's going to be competitive to equities, and then you have the rebalancing premium on top of that. Okay, so that to me, this is a no-brainer for young investors and old investors.
Yeah, and obviously that's a lot for any investor to digest. The tact I've taken in the past is, you look at your equities and they're a great long-term growth engine. This is going to look a lot more like a higher volatility hedge fund, right? You're getting some of that equity and bond beta underneath it, which they want to keep, but then you're getting a totally differentiated macro return profile on top. And so, right, clients that want something a little bit more than just equities, but don't want to give up the return potential, but want that access to a hedge fund-like strategy, the return profile of this should be much more hedge fund-like, higher vol hedge fund-like over the long run, which is both beneficial from a return and a diversification potential.
Yeah, and to your point, Corey, when you look at a hedge fund index, the volatility of that hedge fund index is 4 or 5%. By stacking the systematic macro on top, what's interesting here is that the 60-40 portfolio, last I looked, like a traditional 60-40, you're looking at a client having experienced a standard deviation of between 10 and 12% a year, long term. Of course, there's large variations around that. By stacking systematic macro on top, and the fact that it's non-correlated, on average, we're looking at long-term volatilities around 13 to 14%, right? So even though we're stacking a full stack, because of the diversification benefits, the volatility only goes up a couple of percentage points, right? So you're stacking what we consider to be a decent amount of returns long term without necessarily stacking an equal amount of risks, right? So that's something that is, and at 13%, now it's something that clients are used to. They are getting what they want from the risk side of things and a more diversified version of that higher risk, right? More efficient, higher Sharpe ratio, just simply by the fact that there's three non-correlated return streams. So again, just to recap, I know we've gone through this numerous times in this presentation, but here the objective is long-term capital appreciation. For every dollar that you give RGBM, we seek to provide exposure to a global balanced portfolio and a full extra dollar of a systematic macro strategy. And that is the global balance side is 50% global equities, 50% Canadian bonds. And the systematic macro strategy is across equities, bonds, currencies, commodities, both long and short, and directional. We rebalance all of this on a daily basis, and the distribution is, if any, which we don't expect, but if any, will be an annual distribution. Any questions, Corey?
Can you talk a little bit about the underlying markets? Specifically, you mentioned sort of high level categories, but can you just share?
Sure. So, I mean, the key here is diversity, right? Your Sharpe ratio is directly related to your edge, as well as your breadth of market opportunities. And so you can see here that we have all the major categories across agriculture, bonds, energies, equities, rates, metals, and forex, and a wide variety of markets that we can take advantage of. And one of the it's sometimes interesting to see, especially on the commodity side, how important one or two of these asset classes can be for profits and losses, depending on the year. I mean, last year, cocoa had a huge run in systematic strategies like ours because of the fact that there was I believe that there was a supply shock due to some sort of infestation in the cocoa production that led to a massive upswing in cocoa, and a lot of the strategies were able to make money. So you're just getting, I always say to people, when you invest in things like managed futures and systematic macro, you're probably, that position is probably the most diversified thing in your portfolio. As in a world where hedge funds and active equity managers and active bond managers just stick to their lane of like picking stocks. If you're a market neutral or long short manager, you're in the Canadian or US stock space, maybe some global. This is the systematic macro and the future space is just simply where the broadest opportunities exist, and why I've spent my whole career doing this. It's the most exciting area for me.
Rod, one of the questions here that came in is someone who's obviously familiar with your hedge fund programs asking how different is macro here from the evolution hedge fund that Resolve runs?
Yeah. So this ETF is built for large assets, right? So to grow into the billions and billions and not be affected in terms of our ability to create alpha. The hedge fund that we run trades significantly more markets than what we're able to trade in this ETF. And so what tends to happen in the hedge fund is that most of the really strong alpha, a lot of the really strong alpha comes from these smaller markets that can only be traded in small size. And the hedge fund that we run is still relatively small. And we expect to cap it at some point to keep that alpha going, especially using those smaller markets. So that's the major differentiator here. The other thing is that we run the hedge fund, like our target audience is fund of funds, or people advisors that really understand the value of capital efficiency. We run that one at 20% volatility, whereas this one is run at 10, right? So it's just the 20% volatility tends to be gobbled up by fund of fund managers that have a bunch of non-correlated alt managers. When they put them together, they get a alt fund that is a 5 vol and a Sharpe of 1. It's not very exciting. They want to, that market wants a bunch of 20 vol managers so that when they put them together, they get the ball of 10. So it's, the hedge fund is not for the faint-hearted. And yes, over time we should do better. But regardless, this 10 ball with the very, very well diversified markets here, we run it in our previous ETF. It's very accretive, and it's going to be highly correlated, lower volatility, and exciting.
Rod, if people are trying to get an understanding of how Resolve has performed running these types of systematic macro programs historically. Obviously, at least in the US, you can't show a back test for any sort of registered investment company. Is there anything folks can look at from the other products that you manage?
Yeah, if they go to investresolve.com and they go to the strategy section, the two popular strategies to look at how we've done it. The first one is the carry strategy, which we run for a number of funds. The second one is the evolution program that is right below it. And you got to think about these as we always have. They are excess returns. And so the way to look at the returns here is what would be on top of my equities and bonds. So a lot of the work that we do is for single family offices that give us a portion of their portfolio that we use as collateral. And what we do for the evolution program and the carry program is we stack those returns on top. And so, seen through that light, we're not trying to beat the index, 1 to 1 or the S&P or anything like that. We are actually legitimately trying to stack those excess returns on top. So when you go to the site and take a look, I want you to see it through that lens. What would these strategies have done for me had I added them on top of my equities and bonds? And you'll see everything that we discussed today. You'll see offsetting returns in periods like 2022. You will see, non-correlated on a month-to-month basis, and you'll see positive stacks over the long term in that range that we talked about, the 300 to 400 basis points.
Someone here is curious about other plans we have in Canada. Anything we can share, Rod, on further launches?
Honestly, this will depend on appetite, right? So we're gonna launch this for now. The other interesting thing is that we're launching a US dollar class very soon for RGBM. That's going to be currency hedged because I think this is, there's a lot of money in US dollars, both domestically and globally. So that's kind of the thing that we're trying to push out now. In terms of future launches, it is going to depend on how the Canadian marketplace picks up on this portable alpha return stack concept. I mean, it is in full gear right now in the United States. It is a super exciting space. Canada tends to lag a little bit, and so we got to decide where we want to spend our budgeting dollars and our marketing dollars. But I don't know. We're going to start doing some more marketing, talking more about return stacking and portable alpha. If we see an uptick, there's a lot that we can replicate from the US. We also have a bunch of very large Canadian allocators that are interested in what we're doing. And if any one of those comes in with seed, we will be launching more product in Canada. If you want to explore anything else outside of RGBM, just go to returnstack.com. We have a ton of content. Like we have written prolifically on the topic. Any questions, any concerns you may have in terms of how we stack, what the cost of leverage is, how things react in different environments, we have written about it. And go to returnstacketfs.ca, click on the insights section, go to the articles, read up on them, and explore the other ETFs that we've launched in the US if you're so inclined.
All right, Rod, we've hit the end of the questions here. So just want to thank everyone for joining us, taking the time. Rod, thank you for walking us through this product with such depth. We're really excited. It's one of the first of its kind in Canada. We really believe it's what we would consider a better balanced fund, this combination of stocks, bonds, and systematic macro. We understand it's a lot for people to get their arms around, but it's an incredibly powerful structure. We think very unique, differentiated in the Canadian market, particularly from a tax perspective. So we're really excited about the early adoption and look forward to continuing the conversations with everyone. If you do want to learn more, you can go to returnstacketfs.ca or you can go to returnstack.com and contact us there. Thank you again for the time.
Just quickly, Corey, right before we sign off, in that site, there's a couple of pieces here that I think everybody should review. So in the website here, if you scroll down, all of the informational sheets are here, prospectus, fund fact sheets. We're considered medium risk. That's important in the ETF space. And the presentation we just went through, you can click on here to get access to it. Fact sheet. Currently, we can't show any performance for the first year, but there's information there. Quick overview of for clients if needed. And then this product brief has been super useful for advisors in the U.S. to really try to explain what we're trying to do here. You know, has some nice little imagery as we showed in the presentation, why it's important during bear markets, and then kind of the full connection between the individual sleeves and the stack and what you can do with it. So please do explore the website, make use of that marketing material. And again, go to the insights, lots of webinars and podcasts for you guys to listen to. If you're into podcasts, look up the Get Stacked Investment podcast, where we try to dive deeper into these concepts. So sorry, Corey,
No, great
I
final
interrupted
points.
your goodbye.
Great final points. Yep. And again, all that information is on the website. And if there's any questions that you have, please feel free to reach out and contact us, and we'll be in touch. I want to thank everyone for taking the time today to tune in. We know your time is valuable, and hope that you got something new from this presentation, and have yourselves a wonderful rest of your day. Thank you.
Thank you, everyone.